NVIDIA, Tesla, and Amazon, the three worst performing of the Magnificent Seven.
Investors are reeling after a dismal day on Wall Street. The Dow had its worst day in 2 years, falling more than 1,000 points. The S&P 500 and NASDAQ both sank more than 3%.
What if the tech giants you thought were unbeatable suddenly crashed in one day? The Magnificent Seven. Apple, Microsoft, NVIDIA, Alphabet, Amazon, Meta, and Tesla have all seen their combined value drop by over $1 trillion in just 24 hours. These once unstoppable companies have taken a massive hit. How did they go from being Wall Street's top picks to facing such a huge loss? Stay with us as we dive into this shocking drop and what it means for the future of the tech world and your investments. This is a story you don't want to miss. American stock indexes tanked shortly after Monday's market open. The blue-chip Dow Jones Industrial Average fell by 2.8%, setting it up for its worst loss since September 2022. The S&P 500 dropped over 4%, marking its most painful day since September 2022, while the tech-heavy NASDAQ Composite plunged by 6.2%, its starkest decline since March 2020. Hit the hardest were shares of the growth-focused Magnificent Seven tech companies as investors braced for the possibility of a sharp economic slowdown. Apple shares opened down 8%, Microsoft 5%, NVIDIA 14%, Google parent Alphabet 6%, Amazon 8%, Facebook parent Meta 7%, and Tesla 11%. The Septet, which accounted for about a third of the entire market capitalization weighted S&P at Friday's market close, lost a combined $1.2 trillion in market value minutes after trading began, on pace for their worst respective daily percentage drops since March 2020. Apple and NVIDIA stocks were the biggest fallers in terms of market value. Apple registered a roughly $270 billion loss, and NVIDIA a $380 billion loss. All of the Magnificent Seven are now in a 10% correction, or worse, led by Amazon's 24% expected fall from its July 2nd record, closing high, and NVIDIA's 32% unraveling from its June 18th high. So what triggered this sudden market meltdown? The answer lies in a complex interplay of factors. Firstly, let's examine the economic landscape. The recent jobs report painted a less than rosy picture, with fewer jobs added than anticipated, sparking concerns about a potential economic slowdown. When investors sense economic uncertainty, they tend to withdraw their money, and that's precisely what occurred. Next, there's the Federal Reserve. They've been raising interest rates to curb inflation, but there's been no clear signal regarding when they might start lowering them. Typically, lower interest rates boost the stock market, so the absence of a clear timeline has made investors jittery. If you found this explanation helpful, please consider subscribing to our channel. By subscribing, you'll stay updated with the latest insights and analysis on market trends, economic factors, and investment strategies. Hit the subscribe button and turn on notifications so you never miss an update. Now, let's turn our attention to another key factor influencing the market: the role of AI technology and the shifting dynamics of tech company headquarters. The tech industry itself hasn't been immune to challenges. Companies have been investing billions into artificial intelligence, betting on it to drive future growth. For instance, tech giants like Microsoft and Google have announced multi-billion-dollar investments in AI research and development. Microsoft committed over $10 billion to AI projects in recent years, while Google's parent company, Alphabet, has heavily invested in AI-driven technologies and acquisitions. However, the path to profitability in AI remains unclear. Despite these enormous investments, the returns have not always been immediate or straightforward. A significant concern is the high cost associated with AI development. Recent earnings calls from major tech companies have revealed a sharp increase in AI-related expenses. For example, Alphabet reported a 20% rise in R&D costs, partly due to AI investments, while Microsoft disclosed an additional $2 billion in operating expenses related to AI over the past quarter. These increased costs have led to growing anxiety among investors. The latest quarterly earnings reports from these companies highlighted a gap between the substantial investment in AI and the unclear, or even disappointing, short-term financial returns. Alphabet's latest report showed a slower than expected growth in its AI segment, while Microsoft faced criticism for not yet delivering the anticipated breakthroughs that would justify its heavy spending. As a result, investors are questioning whether these AI investments will pay off or if they are simply adding to the financial burden of tech giants. The uncertainty around AI's long-term profitability has further fueled investor anxiety and contributed to market volatility. Global stock markets are currently experiencing significant turmoil, exacerbated by various geopolitical tensions and ongoing supply chain disruptions. Notably, Japan's decision to adjust its near-zero borrowing costs for carry trades led to a dramatic drop in the Nikkei stock index, marking its worst day since 1987. This turbulence in global markets has created a challenging environment for industries, particularly the tech sector. Economic uncertainty, rising interest rates, skepticism around AI investments, and external pressures are all contributing to the sector's difficulties. In the midst of this broader market unrest, specific events have drawn attention. For instance, Warren Buffett and Berkshire Hathaway's recent actions have influenced market dynamics. The revelation that Berkshire Hathaway reduced its stake in Apple by half has been identified as a factor contributing to the equity market's downturn. Despite the perceived negative impact, it's important to note that Apple's stock currently trades significantly higher than the average price at which Berkshire made its sale. The average closing price of Apple shares in Q2 was $186.49, compared to the $209.27 price on August 5th. This discrepancy suggests that Berkshire Hathaway potentially missed out on nearly $9 billion in additional profit, underscoring the complex interplay between market actions and investment decisions. But this is just the beginning of the story. As market volatility continues and the dust begins to settle, investors face critical questions about the future of the tech industry, the shifting role of AI, and the overall health of the global economy. Warren Buffett's recent moves and the broader market disruptions signal potential shifts and opportunities on the horizon. How will leading tech companies adapt their strategies to navigate these turbulent waters? What role will innovation play in steering us towards recovery? These developments could profoundly impact investment strategies and reshape the financial landscape. Stay tuned as we delve into these key issues and uncover insights that could drive your investment decisions. The path forward is full of potential, and the most crucial opportunities are yet to unfold.